Hi everyone, and welcome back to SALT Talks. My name is Rachel Pether, and I'm a senior advisor to SkyBridge Capital based in Abu Dhabi, as well as being the MC for SALT, which is a thought leadership forum and networking platform that encompasses business, technology, and politics. Now, SALT Talks, as many of you know, is a series of digital interviews with some of the world's foremost investors, creators, and thinkers. And just as we do at our global SALT events, we try to empower really big, important ideas and provide our audience a window into the minds of subject matter experts. Today's focus will not be on the US election, and as our producer Joe said, you can think of this as a bit of a palate cleanser from the news of the last few days. But we will be focusing on pension funds, sustainable investing, and partnerships. And I'm very excited to be joined by a dear friend of mine, Gert Dijkstra. Gert is a senior managing director at APG Asset Management, which is one of the world's largest pension investors. He's been with them for over 12 years, and he was a member of the board from 2010 to 2017. He was previously with ABP, which is the pension fund for government and education employees in the Netherlands. Gert studied business management at the University of Groningen and does further education at INSEAD and Harvard Business School. He's also a frequent speaker at high-profile events globally. As always, if you have any questions for Gert, please just enter them in the Q&A section of your Zoom screen. Gert, welcome to SALT Talks.
Thanks.
Now, tell me a bit about your background. You're obviously Dutch, and you have a very unpronounceable name, so I apologize if I did not get that correct. But tell me a bit about your personal background and what took you into the world of pension fund investing.
Yes, okay. Well, Rachel, thank you very much for this introduction, and the pronunciation of my name was brilliant. Thank you for that. Indeed, I'm Dutch. I was born and raised in the Netherlands. And interesting is that often when such a question is asked, people start talking about their career and what they're doing and the importance of their firm. But thank you for the opportunity, first of all, for yourself and SALT and SkyBridge having me. I'm currently, in the past 7 months, working from home, and that makes well, you might say, we look at a different way to this world and your life. I don't know how you all experience that, but 7 months working from home is interesting and give you food for thought. So one of the things I did, for instance, I picked up playing golf again. Instead of commuting for 1.5 hours from where I live towards my Amsterdam office, I had ample time to try to improve my golf. So that's one interesting thing I've learned. You can shift your time to interesting things. Next to that, I must admit it's challenging to get used to have just one door between your professional work and your family office. You might say you're working of living with your family, and so often that's interesting to have together a morning coffee, but it's also challenging to in the evening get away from your work and things like that. So my life has changed. As you rightfully mentioned, I studied at University of Groningen, did an MBA over there, walked around in consultancy, different consultancy firms for, let's say, 10, 15 years, doing different things, marketing, strategy, M&A. And I ended up 1.5 decades ago, a bit more than that, in the investment environment, the institutional investment environment for large Dutch pension funds, which gave me the opportunity to fill in different roles, have different challenges, and but also to travel around a lot, also driven by having offices in New York, in Hong Kong, and since not long ago in Beijing as well. So that's a bit of my life. And I'm looking forward to the coming season because I'm an enthusiastic skier, but currently it's pretty challenging to leave the Netherlands and travel to Austria, for instance, where we often go, because of the COVID measurements. It's challenging to plan your ski holiday. So I do hope we mostly go around Christmas, but currently the chances are low that I will be skiing during Christmas. So that is an introduction, Rachel.
No, that's a great overview. Thanks so much, Gert. And if you've just taken up playing golf, then we should probably have a game because I'm probably at your level. So it would be nice to play with someone that's just as bad
Love
as me.
to do that.
But you mentioned your, global mandate, and I want to dive into that a bit deeper later on. But for the benefit of those in the audience that don't know much about APG Asset Management, could you give an overview of the company as well?
Yeah, sure. Yeah, sure. Love to do that. Well, APG Asset Management, let's start with a bit of history. At the one hand, we are a very old firm, founded in 1922 when the Dutch government started a pension fund. So, and many years, in my view, there happened nothing until 1996 when the pension fund was privatized. And then you suddenly see that there is a broad mandate. You see a lot of new asset classes being introduced, going global. And when I started around somewhere 18 years ago, we already were into New York, North America, fixed income, real estate, going into private equity, hedge funds, commodities. So that was a really interesting period of time. In 2009, the Dutch government introduced a new law, and the Dutch pension funds has to be split into the pure pension fund and the executing asset manager. And that moment in time, APG was founded. And currently, APG Asset Management is the asset manager for 4 Dutch pension funds, of which the Civil Servant Educational Pension Fund, ABP, is by far the largest. The second largest one is the pension fund for the building construction industry. And I mentioned those two because they are also, next to that they are our biggest clients, they're also our shareholders. So I live in a very interesting environment where my clients are also my shareholders. I maybe touch upon that later. Currently, at least at the start of 2020, we had around 540 billion euros assets under management. In US dollars, that's around 635 billion, I think. So I mentioned that because that ranks us in the top 10 of pension funds globally. And I think we are characterized as a global leading long-term and responsible investor. And the responsible part, I like to elaborate certainly later on. An important characteristic is that we have a large staff, 900 people working for us. So we have 75% of the assets we manage internally. For the other 25%, obviously, we select and monitor external managers. We are an active asset manager in the sense that we don't believe in standard commercial benchmarks, but we do believe in being smarter than the market in the long term. Again, I already mentioned 900 people working from the Netherlands, from New York, Hong Kong, Beijing. And we embrace typically the responsible and sustainable investment beliefs of our clients and ourselves. So that is, I think, in a nutshell, what APG Asset Management is.
No, that's a great summary. Thanks, Gert. And, when we look at the sovereign wealth fund and pension fund world, by far 2 of the largest themes or trends that we're seeing are the move to sustainable investing or the increase of sustainable investments, but also the rise of co-investments and club deals between other asset owners. Is this something that you're seeing in Holland and with APG specifically?
We don't only see it, but we initiate it, I tend to say. And then it's not a new tendency. You rightfully mentioned that as an important tendency in the world of large institutional investors. And I remember that I think already in 2018 or even earlier, Texas teachers had in their strategy, so the Texas Teacher Pension Fund have had in their strategy already partnering, asset owner partnering included. And there's a beautiful Harvard business case on that if you like to read more about that. But having said that, it's typically a tendency we already have had in especially investing in real assets for quite some time, but it also picks up on in other areas. And also from an academic point of view, it's interesting to read some of the work of S.B. Monk from the Stanford University, who has published quite a lot of very interesting and relevant research on networks in the financial sector. Having said that, for us, we focus on, let's say, 5 pillars which are part of our asset owner partnering initiative. And if you look at our strategy, this asset owner partnering is typically well needed for as part of our strategy. The first pillar of that is boosting returns. Typically, if you look at the future compared to what we could return in the past decade, it is far more challenging to find the same level of return. So to find access to attractive yet difficult to implement long-term investments, partnering is well a very good option. And I think it's interesting example of that is that we collaborate, and it's public information. We collaborate intensely in the past year with South Korean fund, NPS. We already did 2 deals together, one toll road in Portugal, student housing, real estate in Australia. And those are typical examples of 2 large asset owners collaborating. And this is an example where you talk about 2 pension funds investors, but you see that we collaborate with sovereign wealth funds. A good example is that we already for a long time together with GIC from Singapore invest together. That's public information as well. But what's new is in the past, let's say 2 to 3 years, we talk also with family offices, something I wouldn't have done a decade ago. So everywhere where you see long-term and responsible investors and investment ambitions, large institutional investors find each other. So the first reason to do that is obviously boosting returns. The second important reason to partner with other asset owners is lowering costs. So try to find cost effectiveness in direct investment in, for instance, in real asset, but also cost efficient deal sourcing or processing, and even negotiating fees you might see as part of the agenda of the cost reduction part of asset owner partnering. Then a third important driver for this tendency of asset owner partnering is to have more impact, more responsible investment impact. So more control over investments, more increasingly applying all aspects of responsible investing. And let me give you 2 examples. We were one of the founding members of a benchmark called GRESB, GRESB, that stands for Global Real Estate Sustainable Benchmark. And that is currently a benchmark used by around 180 asset managers and investors to monitor and report on their real estate investments. And it's typically geared towards reducing energy usage, reducing water usage, things like that. And we, as a next step, we also try to develop a lookalike benchmark for infrastructure, which is a bit more challenging. And another example I like to mention to you is a very recent initiative, which we took together with another Dutch pension fund investor called PGGM, but also with an Australian pension fund, Australian Super. and the Canadians, British Columbia, which is an initiative for what we call AOP SDI, a platform where we can report, well, let's say, source data and report on listed companies with regard to their sustainable development goals and results, if, for instance, in carbon reduction. That's a new example. So that is typically something we need the partnering with large global investors to set standards in that area. A fourth reason, you might say, driver for cooperation with other large long-term investors is obviously to share ideas on innovation. We share our ideas with some of the large investors, sorry, to see whether or not we can jointly initiate innovative pilots. We do that together with buy-side parties, but also with sell-side commercial parties like GP Morgan. We did an artificial intelligence pilot with regard to sentiment recognition in the publications of central banks. So basically, we don't have enough budget to do it ourselves, but if you share your budget, you can do far more innovative work than when you do it alone. And if you allow me, the last, fifth and last driver for asset owner partnering for us is human talent. What we try to do is to offer, let's say, our professionals, which somewhere between mid-30s and mid-40s, to pick up some experience abroad with one of our peers. And there is typically the period in most careers where you're not yet at the highest management level. You have had your university follow-up post-academic experience, and you're looking for something new. So being able to offer young professionals in that age category to have 1 year in Japan or in Korea or in China or in North America, that is typically a benefit as well, becoming an attractive employer. So that is more or less the scene behind our ambition to implement an asset owner partnering program.
I think that all those, those 5 points obviously really make sense. I'd want to pick up on the third one that you spoke about and go a bit deeper into the impact side. And, ESG has become such a highly used, or some would say overused, acronym and can take on many different forms. Can you maybe just outline how APG actually views sustainable investing? And also I'd like to, you mentioned that your clients are also your shareholders, and maybe how that plays into the equation there as well.
Yeah. Well, to pick up the last part, yes, we are obviously very close with our clients because they are client and shareholder. So if you talk about target setting and investment beliefs, it's always very near. You might even say that it's an iterative process where we advise our client and the client comes back. And so that works. So if you look at our investment beliefs, one important investment belief obviously is that we truly believe, and there is also sufficient academic research for that you can invest in a sustainable and responsible way and keep sound returns. So you can maximize returns and be sustainable and responsible at the same time. That's a strong belief. And again, we have, there is academic, in the meantime, we have academic research sufficiently to underpin that belief. So if you try to translate that belief into policy and practice, you might say we have, and it differs a bit, to be honest, on the E, the environment, the S, the social, and the governance part. But we have, let's say 5 parts of our policy which, well, give content to that belief. And first of all, we have a corporate governance policy I like to elaborate on a little. We talk about exclusion, about inclusion, and that's the most interesting part I like to share with you more elaborate. Sustainable development investments and carbon footprint or climate as a theme. What's important for us is that we typically start with the targets of our client. Our client has very clear, given us very clear targets. They already did that for the period in time 2016, 2020. So basically your question is on a very well timed, because we start with a new set of targets for 2025. And the targets for 2025 is in the listed equity environment, a 40% carbon footprint reduction in the listed equities. And that the benchmark is, by the way, 2015. So that's the baseline, but still challenging. Number two, another example of targets, or really a quantitative target, is that we have to invest 15 billion euros in clean, affordable energy, which, by the way, is directly related to one of the sustainable development goals from the Paris agreements. For the specialists, that's sustainable development goal number 7, clean and affordable energy. We have to reach that target by 2025. Then an interesting one might be the phase out from coal and tar sands from our portfolio, also by 2025 or earlier. And then we have to find a portfolio fully aligned with the Paris Agreement by 2030, and more challenging, and I'm not sure whether or not I will be still in APG Asset Management, a net zero emission portfolio by 2050. So those 5 very clear quantitative targets drive our policy and investment decision making. And obviously we can't do that without clients having those type of ambitions. Having said that, it's obviously very challenging to implement that, but that's what we do, and that implies that in each and every investment decision we make, and I gave some examples in the listed equity, but the same goes for real assets, that we make our decision from 4 angles. Obviously from a return angle, obviously from a risk angle, cost angle, but certainly also from the ESG angle. And they all have the same weight for a decision to be made, yes or no, to an investment proposition. So that's the way we translate belief towards targets, towards implementation.
That first one that you mentioned, Gert, the 40% carbon reduction, do you apply that on a global basis across listed equities, or how does that work?
Yeah, yes, it's very clear that at the end it's for the global portfolio. And it's a very, very interesting topic you now bring up, because, for instance, when I mentioned there is a difference in pace between the E, the S, and the G, when I take governance, in Europe, it is, and in the Anglo-Saxon world, you might say, but certainly in Europe, we have a increasingly intensive dialogue with the boards of the corporates, the listed corporates in which we invest, to steer them towards a more ESG, if necessary, a more ESG-like policy. So we have in Europe, for instance, a Focus Europe portfolio, equity portfolio, with an increasingly limited number of companies, because it's very labor intensive to have all those dialogues. So one of the effects you see is that the number of companies you invest in decreases, but the time invested increases. In China, we're now implementing a China focused fund. There goes the same, a limited number, but you see there that at the environment and social, it works, but governance is quite a new topic for the boards of some of the Chinese listed companies. So there you have to take more time before you are successful in implementing your policy.
Mm. And we've had a question coming in from the audience. It's similar to a question I was going to ask, but they've actually worded it much better. So I'm going to select their version. They've said, why do you think it's often the Dutch and the Scandinavian pension funds leading the way in ESG and impact investing? Do you think it's a socially driven viewpoint, or is it also tied to the political stance?
Well, that's indeed a very good question. And to be, my easy answer would be, I don't know. But when I think about it, and often we are challenged to think about it because our Canadian peers often talk to us and call us the enlightened Europeans. They're obviously very proud, but you can also start thinking about why the heck is that they are doing that. When you talk about the Scandinavian, one of my dear peers is a Norwegian oil fund, so NBIM, Norges Bank Investment Management, and that is typically a fund where there is a strong political connection historically, and I can imagine that you see there more political influence than in some of the other pension funds. For the Netherlands, I must say that there is not a strong or any, if you like, political connection. So then you can come to a discussion about the Anglo-Saxon world and the Rhineland model. So the Anglo-Saxon model and the Rhineland model. And when I was at the university in a town of which the name you pronounce brilliantly, I was educated with a strong shareholder focus. When I look in my library, I find the old books on shareholder value. Still, the Netherlands is at the brink of the Rhineland model. So I think we picked up earlier from an academic, maybe for the societal, and maybe even for the political angle, some flavor of the movement early from shareholder towards stakeholder movement and modeling and thinking. And if I look at the board members of my largest clients, so being the Dutch pension funds, they want to be part of the Dutch society. They want us to focus on our role in society. So yes, that's maybe a bit of a long answer, but I do think that here in Europe there might be a bit earlier influence of societal, or if you like, stakeholder thinking, than it might be in other parts of the globe. And what's interesting for me is that we have had a fierce discussion some years ago with regard to the tension between return focus and which is part of your fiduciary duty, which is rooted in the prudent person rule, and whether or not you could broaden your scope towards ESG, so sustainable and responsible investing. And at the moment that there is sufficient academic research and proof that you can do both, so be a responsible and sustainable investor without losing return, then that's the solution. That's the way forward. And we really had some enlightened CEOs and leaders here in Western Europe who brought us on that road. And I see the same, by the way, in some of the same thinking in some of the US-based large pension funds in terms of the Californians, the CalPERS, etc. who do pretty much the same thinking as we do. So it's not anymore the enlightened Europeans, I must say. So I'm not sure whether or not I answered the question right, but that's some of my thoughts about it.
No, I think that's very explanatory. And, you know, if you do look at the academic research, which shows that sustainable investing actually leads to greater returns, you're doing a fiduciary disservice by not investing sustainably, aren't you? You can almost flip that around. You do mention US pension funds, and we've had another question coming in from the audience about that, so I'll address it and then dive a bit deeper into asset classes. But given that, you know, there are many state employee pension funds in the US that have this large funding gap, you know, some of them are very heavily underfunded. What do you think can be done here, and what would be your advice or guidance to some of these states that are facing large funding gap issues?
Yeah, well, I think it's an important question, but at the same time, pretty difficult for me to answer, in the sense that I'm curious about the reasons behind the gap. Basically, if you can see what options, which instruments a pension fund board has, it's limited. You can say we can raise the pension premium in, we can lower the pension premium out, we can take more risk in terms of investing, but those are basically the limited instruments the boards of pension funds have. Maybe I can illustrate it by the following. We did some research based on the data our clients gave us, that which gave insight in which part of the premiums paid out were raised by our returns. So if I make it more visible, if you take 100 euro, or for you maybe 100 US dollar, but for me 100 euro, the question was, from each 100 euro paid out today to a retired fireman or a retired teacher, which part is brought up by APG Asset Management? So by what are the investment returns? And the answer to that question is I think very interesting. That's 75 euro. So 75% of the premiums paid out are based on investment income. By the way, 8 euro is the contribution on average of the employee. 18 euro is the contribution of the employer. And again, 75 is the work we have to do. And I'm not sure whether or not it is the answer, but those are the limited options a pension fund board member has to influence the gap. So that's part of, let's say, part one of the answer. Part two is, there is now a gap. So in a low interest environment, you have to seek for more risky investment opportunities to get a acceptable return for the coming years, for the coming decades. So one movement forward, one way out, is to find controlled, but still more risky and more return-giving assets, which is a dangerous route. But if you don't go that route, it will be extremely difficult to bridge the gap. Obviously, the other one is to cut the pension premiums paid out, which is not favorable for society. It's, well, in many senses, it's not a good way to move forward. And obviously, the other one is to raise the pension premium paid at this moment by the employees. And what we also did is, currently with some of the pension funds in the Netherlands, the participants already pay 1 day per week of their salary in the pension pot, so around 20%. So that's extremely high, extremely high. So in the Netherlands, it's for some of the pension funds extremely difficult to use that instrument to keep the coverage ratio at a sound level.
Yeah, and I think well, if you suddenly change the amount that you pay out, as you say, that has a whole lot of social implications, and it really should be the method of last resort.
The good news is what we have here in the Netherlands, and I know you know our model. We have the 3-pillar model, where the first pillar obviously is that somebody who is working and living in the Netherlands becomes 67 currently gets a state pension. We don't interfere with that. Then the second pillar is typically our market segment, where somebody who is working in the Netherlands on a mandatory basis becomes participant of a pension fund, an industry pension fund. And then when he or she becomes 67, that is paid out as well. And the third pillar obviously is that you can arrange your individual pension scheme. That's a market segment where mostly here the insurance companies are active.
And did you know, just quick fact for you, Gert, that in Bahrain you can retire at age 49 after 15 years service. So as you can imagine, there's quite a difference in the pension model there.
Yes.
We've had a whole host of other audience questions coming in. One is, I know you spoke about the public equities and how you look at that, but there's a question that's come in. It's got a few parts to it. Firstly is, how are your policies implemented outside of public equities? So, for example, in the private equity and venture capital space. And then the second part, do you invest across the board, or you prefer early stage innovation, versus mid to late stage, or do you prefer any sectors or industries as long as they meet those 5 pillars that you spoke about previously?
Yep. Let me first take the last one. Typically, pension funds, we love long-term predictable cash flows. That's because we have to deal with the liability of our clients. So there are clients' liabilities, and so the cash flow out is pretty predictable. And so we love long-term predictable cash flows, preferably with a bit of inflation compensation in it. So that's why we invest in toll roads. That's why we invest in some of the energy related industries. Having said that, that was in the good old days, because those markets have become very, very competitive. So to be positioned ideally for those long-term cash flows, so for what we call the brownfields, we've moved towards greenfields. And we have already some mandates from our clients where we can fully invest in venture capital, early stage, but still in terms of size, it's not that large. So yes, we are moving towards earlier stage in terms of investing, but at the end, we still love our long-term and predictable, let's say, brownfield cash flows. So yes, we move to greenfield. Another important thing is not only in investing, but also in, you might say, behavior or governance. What we did, what we not did, let's say a decade ago, was interfere with project developers, initiators, innovators. And typically in the past years, we moved towards also in what you might say the life cycle value chain, in early stage, where we, together with entrepreneurs, develop their projects. And if you allow me, two examples. One is, Rachel, I would advise you, when you go, whenever you come in London again, go visit the Westfield shopping mall. That's typically, it is quite near the Olympic Stadium. It's a beautiful upmarket shopping mall. And we already sat at the table together with the project developer when there were still the old industry buildings. So that was a very early stage. The same goes for a hotel chain, which started in the Netherlands, by the way. It's called Citizen M. It's a very easy to go hotel chain. And the same goes there. We stepped in a very early stage there. And that are two illustrations of actions we wouldn't have done 15 years ago, 10 years ago, maybe. But we are now trying to position us as a, well, investor for the long term, but to be, to make that long term interesting, we step in early. So that's part one of the answer. The other question was about, yes, you can implement your sustainable responsible investing policy in listed equities, but how do you deal with, for instance, private equity or venture capital? We have a pretty large private equity portfolio, around 20 billion euros, and most of them, or maybe all of them, are funds, are co-investments, secondaries. So we always have to deal with private equity, with GPs, with general partners, and we have to convince them that we really love them, but they need to implement our ideas on sustainable and responsible investing. And that's challenging. So the question is absolutely spot on, because that's a challenging part, especially in an era where there is so much money available for real assets, for private equity, for venture capital. So at the one hand, you want to be an LP in the top quartile GP league. And on the other hand, you want to negotiate that the private equity firms start implementing, or at least living up to, your sustainable and responsible investing principles. The good news is many of the large private equity and top quartile private equity firms have adopted, in the meantime, similar responsible investing policies, and using more or less the same responsible investing criteria. But I think the truth is, it was and still is challenging to get the right level of transparency, the right level of attention for those aspects. So the honest answer is yes, some of the asset classes are easier than the others, and private equity is not always easy to get your ambitions in terms of sustainability and responsible investing implemented. But you need to have a permanent dialogue with those private equity firms. And one step further, I know that in some cases, private equity firms said, no, thank you, we don't want your money because it's too challenging, etc. So yes, that's really a challenge. Good question.
Yeah, and I guess with your size, 635 billion, having to deploy so much capital, you're already shrinking your investable universe a little bit there as well. It's a lot of money to put to work. Sure. We've only got time. We are actually over time, but I'm going to ask one more question from Sebastian Javadi. And thank you, Sebastian, because he's a great Salt Talk supporter. But he said, how do you balance the need to invest in companies that are responsible on the carbon side versus companies that aren't carbon responsible, but they're critical to the functioning of our economy? And the example that he gives is, flying in planes, for instance, is not a carbon-friendly activity, but critical for the functioning of our global economy, or maybe not so much in the last few months from a passenger perspective.
Yeah.
But how do you sort of balance out that tension between, necessity for the economy?
Yeah, but Sebastian, great question. And typically, a great illustration of one of the dilemmas you encounter when you have an ambitious, responsible, sustainable investment policy and try to implement it. You typically, I see my colleagues wrestling with those type of dilemmas. And the way out, obviously, is to start and maintain dialogue with the boards of those companies and try in time to move them towards a situation where they fit into your policy. And maybe, I don't know whether or not we have much time, Rachel, but just let me briefly explain our inclusion policy. We only invest in companies after a few steps. And the first step is to assess whether or not they are a front runner or a laggard in terms of sustainable and development entrepreneurship. If they are in the front line, then you look at the return options, etc., and then it comes into the portfolio. If they are a laggard, and those are the most interesting, and that applies most on Sebastian's question, I guess. When they are a laggard, you have two options. If you see that there is an interesting return perspective, you might say, okay, they are potentially part of the portfolio, but we have to start a dialogue. If the return perspective is negative, they typically are not in your portfolio. So there you see the mechanism we apply, but that is a bit of a technocratic answer on a very, very deep dilemma we encounter every now and then. So Sebastian, thank you very much for that question. It's spot on.
No, I think that's a great answer. And if it's a case of the laggards, and that's an opportunity for you as well, isn't it? As long as the willingness, as you say, is there from the actual company to improve. I do just want to ask, I know I said it was the last question, but I do just want to ask one last question. And I had about a dozen questions that we didn't get to, and we didn't talk about the election, so I'm happy about that too. But how do you see the post-crisis world and the role of the responsible institutional investor within that?
Given that that is a beautiful last question in which I can spend an hour, but you want me to give a brief answer. I still like to have two or three perspectives. Number one is from the geographical point of view. We guess that if you look at the three large economic blocks, starting with the US, it might be the case that US comes out of the corona crisis less dominant, partly because there's a division between the states, which is very, very visible and became even more visible, I guess, during the COVID crisis, corona crisis. And there is a very strong market and individual orientation. So that might be the background of the US being a less dominant. You have to see that in relation to the second economic bloc, being China. And although China might come out a bit stronger, typically they cannot take over the leading role globally. The country is not sufficiently trusted yet in a global stage. And there is evidence sufficiently for that. And then Europe, my own environment. What I see is that Europe is populist divided. And we have to get our act together in decision making before the European Union can become a relevant, really relevant part on the global stage. And that is not the case yet. Although I must say that recently we had a European green bond issue, which forced the different countries to work together. And that's a very interesting signal, I must say. So that's perspective number one. If you allow me a second one, that's a technology. Because we do think that the crisis, the COVID crisis, might reinforce technological trends in which you can see that US and China have far more stronger technology sectors than Europe. Let me illustrate that with 1/3 of the engineers globally live in China. So that is a potential source for innovation, which is great. Then you might say that some of the industries like pharmacy and biotech will continue to grow, maybe boost even. Mass entertainment, we think, might take a hit over digital individual entertainment. And one other thing, obviously, is that the tourist industry might come out quite differently than when we started the investment company. And my last three remarks on the COVID crisis is one, what we see is that not necessarily the US dollar will stay the only reserve currency. In the midterm or long term, you might even say it's not inconceivable that interest rates and inflation will take a different path and start to rise sharply. And one other consideration might be that perhaps there will be a turnaround in the popularity of illiquid investments, and listed markets being more transparent and being more digital might be reassessed and being, for large institutional investors, becoming more relevant and interesting. Well, let's keep it there.
Thank you so much, Gert, for summarizing what could have been an hour answer in about 3.5 minutes. That was very impressive. And we are slightly over time, but I just wanted to say thank you so much for your really thoughtful and in-depth answers and providing such a great window into APG Asset Management and yourself as well. So thank you very much, Gert.
Good. Well, thank you, Rachel. Always great to have a dialogue with you. Thanks.